How's it going, everyone? In today's video, we're going to talk about 7 stocks that you can buy and hold forever. These are stocks that have staying power. They'll keep chugging along and doing their thing no matter what's going on in the economy. These are set it and forget it type stocks. While these might not be massive growth stocks like Apple or Tesla, they do serve a purpose within a portfolio. And in my opinion, I think that everyone's portfolio should have some stocks like these. If I had to pick a bunch of stocks to buy and put in a time capsule that was opened up in 50 years, there's no doubt that these stocks would be in the time capsule. Now, they wouldn't be the only thing that's in the time capsule, but they'd definitely be in there. For each of these stocks, we're not only going to focus on key metrics like PE ratio, dividend yield, and payout ratio, but we're also going to look at how well diversified the business is and how well positioned they are to not only survive, but also to thrive. When we open up that time capsule in 50 years, I want to see these stocks appreciate in value substantially and also throw off a really large dividend. So what that means is that I want to see stocks that can continue to grow even when times are bad and also continue to grow their dividend over time. If you think that I missed a stock that should definitely be on this list, throw a comment down below and let me know what you think. I make 2 videos a week on stocks and investing with the goal of helping you to make more money. If you like these topics, hit the subscribe button, hit the notification bell, and you'll be alerted when new videos come out. All right, onto the time capsule stocks. The first one on our list here is Mondelez International. They pay out a dividend of $1.26 per year, which is a dividend yield of a little over 2%. They've been growing their dividend for 7 consecutive years. This is on the lower end, but they've only been around since 2012. Mondelez is the former Kraft Foods global snacks and food brands division. They were spun out of Kraft in October of 2012. They have a huge portfolio of products and they're in stores in over 150 countries. They have so many brands that if you like snacks, you have at least one of their products in your house right now. You've probably had one of them within the last week, day, or even eating it right now. Now, this isn't a complete list of their products, but here are some. They make Ritz crackers, Triscuits, Wheat Thins, Chips Ahoy, Tate's Cookies, Oreos. Fun fact here on Oreos, did you know that it takes 2 hours to make an Oreo cookie? They also have Sour Patch Kids, Stride Gum, Trident Gum, Cadbury Chocolate, Toblerone Chocolate, Halls, Philadelphia Cream Cheese, and Tang. Now, this isn't a complete list of their brands, but I want to give you a flavor of what brands Mondelez owns. My point here is that people love to eat, people love snacks, and that doesn't change even if the economy is bad. And their portfolio is so vast that even if one of their brands goes out of favor, they have others that will fill the gaps. And they also have room to expand into other categories and expand within their categories. There's a lot of room for growth with Mondelez, and I think that this is a good one to put in the time capsule. Right now, their PE ratio is around 25, so it might be a little bit overpriced from my perspective, but it's worth taking a look at Mondelez. Next on our list, Proctor and Gamble. Proctor and Gamble has a dividend of $3.16 per share, which is a yield of a little over 2.25%. Most importantly, they've been growing this dividend for the past 63 years without fail. And here's another one that has a payout ratio that's right in the sweet spot of 60%. If you're in a grocery store and walking down an aisle where they're not selling food, it's likely that you're passing all sorts of P&G products. Here are just some of their brands, and there are so many more. Procter & Gamble not only has a bunch of products across different categories, but they have several products within a given category. For example, laundry detergent. They make several brands of laundry detergents, including Tide, which is a more premium brand, but they also have lower priced alternatives like Ace, Gain, and Era. And I think this is important because people need laundry detergent no matter what's happening in the economy. They need to wash their clothes, right? But they may switch from using Tide to Gain, for example, which may save them a few bucks. But that money still ends up in Procter & Gamble's pockets. P&G has around 20 brands with over $1 million in revenue annually. In addition to that, they have so many more brands that are huge but under the $1 billion mark. I think that Procter & Gamble has the ability to maintain and also thrive no matter what's happening in the economy. They are constantly acquiring new brands and growing new brands. They're a marketing powerhouse. And for this reason, I think that Procter & Gamble deserves a spot in the time capsule. Right now, they might be a little bit overpriced from my perspective with a PE ratio of over 25, but I look to see that come down and add some to my portfolio once that PE ratio comes down a bit. All right, on to the next one, 3M. 3M pays out a dividend of $5.88, which is around a 3.5% yield. They have an amazing track record of growing their dividend over time. They've consistently grown their dividend for the past 61 years. So each year of the past 61 years, they've increased their dividend. This is great. This is what we want to see. And their payout ratio is 66%. So it's on the higher end of the range of what I like to see, but it's still below 70%. And for me, that's what I look for. If you go over to your desk area and open up the drawers, I'm sure that you'll find some 3M products in there. One of their biggest brands that they're most well known for is Post-it, the little sticky notes. But they also make a ton of other stuff in a range of industries. If you take a look at the 3M website, you'll see that they make products across a range of industries. They make products for automotive, commercial solutions, communications, consumer goods, design and construction, electronics, energy, healthcare, manufacturing, safety, and transportation. And this is exactly why 3M makes it onto the list. They have a nice dividend yield, they have a great track record of growing their dividend, and they have a huge portfolio of diverse products across a range of industries that they are positioned well in. Right now, 3M's PE ratio is 19, so I consider that to be a little bit undervalued. Next one for the time capsule, Toronto Dominion Bank. They have a dividend of $2.42, which is just under a 5% yield. While they only have a streak of 3 years for consecutive dividend growth, if you go back and look at their dividend growth rate for the last 25 years, it's 11.3%. This is amazing. This is what we want to see. And their payout ratio is right in the sweet spot. It's 59%. While it might be a little bit counterintuitive to include a bank here, I think that TD is a little bit different because they're a Canadian bank. They're a little bit more regulated than US banks, and they have little exposure to investment banking and trading, which are cyclical and risky. They're also the 5th largest bank in North America with over 2,300 retail locations across North America, and they have over 26 million customers globally. Another thing that I like about TD is that they've developed a culture of innovation. They have an employee ideation platform called ID8. They launched this platform in February of 2019, and since then, 13,000 ideas have been generated. They've benefited over 2 million customers and over 22,000 colleagues. This is pretty impressive for such a new platform. TD's PE ratio is just under 11, so for me, this one's a little bit undervalued as well, and I think deserves a spot in the time capsule. Next on the list is Coca-Cola. Coke has a dividend of $1.64 a share, which results in a dividend yield of about 3.25%. They also have 57 consecutive years of dividend growth. We like this. Their payout ratio is a little bit high for my liking at 76%, but that doesn't dissuade me from holding the stock forever. I don't know if this one's surprising or not, but I thought that either Coke or Pepsi should have a place on this list. Most people prefer Coke, so I put Coke on the list over Pepsi, but I think a strong case could be made for either. It goes without saying that Coke has an incredibly strong position within the non-alcoholic beverage market. If you go down any aisle selling drinks, you'll see tons of Coke products. They don't just sell Coca-Cola, they probably sell around a third of the beverages that you see in the grocery store. And it's not only soda, but it's water, sports drinks, juice, tea, and more. They've got their hands in everything that's non-alcoholic beverage. Talking about all these Coke products makes me think about a couple things. One is that freestyle Coke machine that you see in some restaurants. I just love that thing. You can make all sorts of combinations of flavors, and it's really neat. Some of the flavors are probably not good, but you can make them if you want to. Coca-Cola is another company on this list that's a marketing powerhouse. They make products that people like and will continue to like and buy no matter what's happening in the economy. And before we move on to the next one, I just need to show you guys this. This is a complete throwback to the early days of YouTube. If you haven't seen this, you have to check it out. These guys put on an amazing show with Coke and Mentos, and they might just be the top individual consumers of Coke in the world. The next stock on the list is probably the least well known of the bunch. It's Chubb. Chubb has a dividend of $3.12 per share, which is a little over 2.5% yield. They also have a 54-year history of continually growing their dividend. This is a theme of the stocks that we have on this list where a bunch of them have long histories of growing their dividends. And their payout ratio is again in that sweet spot, 63%. Insurance might not be the most exciting business, but we're not looking for exciting things to invest in. And everyone needs insurance, no matter what's happening. Chubb has been doing insurance for a long time. They're the largest property and casualty company in the world that's publicly traded. They also provide other types of insurances like health insurance, life insurance, and reinsurance. You can see here that the US makes up the bulk of their business, but they're also diversified globally, that they have a third of their premiums coming from outside the US. And they're also very diversified in terms of premium by type of product. Property and casualty insurance makes up the bulk of their business, but it's split across large corporate commercial, middle market and small commercial market, and wholesale specialty commercial. I wanted to include an insurance company on the list here, and I think Chubb stands out from the pack, and they really focus on growing their dividend over time, and their business is fairly well diversified, and that's why they made it onto the list. Chubb's PE ratio is 25, so I'd look for the stock price to come down a little bit or their earnings to boost up a bit before buying the stock. All right, the next one, Waste Management. Waste Management has a dividend of $2.18 per share. This results in a yield of under 2%. While this is definitely on the low side, I'd look to buy Waste Management when the price comes down, which would mean that we have a better dividend yield. Waste Management has 16 years of consecutively growing their dividend. While it's nothing to sneeze at, it's definitely on the low side for the list that we have today. Waste Management's payout ratio comes in at 56%, and that's right in the ballpark of what we're looking for in that 50 to 70% range. We've talked a lot about food products, beverages, household items. That stuff all needs to go somewhere, right? And that's where Waste Management comes in. I'm guessing that you've seen their green trucks rolling around the streets. If not, take a look. Waste Management's main business is in the collection, transfer, and disposal of waste for commercial, residential, and industrial customers. They also generate revenue through operating landfills and through recycling. So their business is pretty resilient here. They serve a wide range of customers, and as long as everyone's producing waste, which I think that they will be, Waste Management has a business. Their business also has massive barriers to entry. It's not easy to get into that business, and it's fairly well protected. For all of these reasons, I think that Waste Management is a stock that you can just buy and hold forever and not worry about. That's my list of 7 stocks that you can buy and hold forever, drop into a time capsule, and open up in 50 years and see what you've got. Check out my next video here for more on dividend investing and more ways to make money in the stock market. All right, I'll see you in the next video.